Hey, what's going on, everybody? This is Peter here with Real Estate Trends and Market Updates. I just want to say that as this change goes on with real estate and how we continue to go down the path of a turbulent time, and they are a turbulent time for seller and buyer when you're trying to jump into a real estate market and you experienced the past couple of years, which I feel like people's memory is only like 2 years long, because when you get a 2 year market cycle that is solid fundamentally and continues to go up, granted, we've had a long expansion time from 2012 all the way up to 2022. You see the changes in people's mindset of like, hey, this is never going to happen. This is never going to change. And things are really going to, expand, and there's going to be no contraction. So, when the world's in flux, when there's everything changing from one thing to the next, the only thing to do is make sure that we go off the updated information that we get from any type of news source that we feel is viable. And through doing research and continually staying on top of, for one, for us right now as real estate agents, real estate professionals, or people that are in the market to buy a property, or just make sure that they feel comfortable on transacting, or just feeling comfortable on making sure that they can go out to the store and buy milk, or buy rice or beans, or any type of luxury at the store, an extra bag of cheese or something like that. That those things people are really saying, well, no, I don't want to spend that money because it's contracted so much recently due to supply and demand, due to inflation, due to price changes at the gas pump. So now we're in this market where each time the feds meet, it seems like it's this deja vu of like, okay, well, it's just a bad day again. It's just a bad day again. So the feds meet today and tomorrow, and they'll finish up and wrap up by tomorrow, the 14th of December, and they'll go over what their ultimate change is to most likely rising interest rates. And we look to see, it's the 13th of December, we look to see what we've seen the past year in inflation. And luckily, it came back in November at 7.1%, comparatively to in June of 2022 at 9.1% is where it peaked. So, which is good news, because we had the jobs report came out and it said it added 237,000 or 267,000. I forget which, it was a 37 or a 67. It changed a little bit of the market of that wise, that you're looking at, where, you see a job market that's consistently still adding jobs to those, the payroll, and you wonder why are these still going up? And you see big tech companies saying, let's pull back. There's a lot of contraction, we got to hold off. And then all of a sudden you get this, and this is a little bit of a sigh of relief when you come into looking at the market as a whole. Really, it's it's one of those. It's okay. Well, what do we see here now in front of us? What we have the last 6 months, and where do you think 2023 is going to go? And a lot of people are saying 2023 is going to be a scenario where it's just going to get worse. It's going to consistently get worse. Granted, it's going to get not as good as it is today, so it will probably get a little bit worse before it does get better. But a lot of people have really come and staked the claim on it being something where it doesn't make sense. And they say like, okay, well, the feds are going to continue to bump up that interest rate, and the housing market's going to fall worse than it did in 2008. It's tough to see that, and it's tough to really expect that. And the reason is, and I've said this before, but the reason is, and I'm going to pull up some data here as we kind of go through this, but I don't think it's going to be like that, because of simple fact we don't have the inventory we used to. Going into it, and I'm going to beat the same drum as I usually do. Yeah, I think that obviously, a lot of people are going to get, a situation where they're going to be in trouble financially, because a lot of things are going to change for them. But ultimately, I don't foresee this type of scenario happening where, people are going to be in a flux for the next couple years because we're in this bad real estate market. Because if you look, and this is just real estate in Orange County. So if you're somewhere else, just make sure that you realize we're talking about strictly Orange County right now. Okay. So if you look at, let's see the scenario here. If you look at back in 2006, there was in Orange County, and I'm looking at a graph here, about 15,900 homes on the market. That was in 2006. 2007 was even more than that. There was about, looks to me here, almost 18,000 homes. It looks roughly, it's not touching the line of 18, it's right below it. So it's about 17,900-ish homes, 17,800-ish homes. Now, let's fast forward to where we're at today. Right now in Orange County, just Orange County, we're at just less than 4,000. Okay. Middle of 4,000. So today's inventory, and now I'm reading down here below. So because they don't have actually specific numbers when I'm looking at this chart, but now I see an inventory of 3,182. 3,182. So what is that? 6 times difference of, if I'm doing my math right. So yeah, 6 times, 5.5 times difference of what it was, what it is now. So that all being said, and that accumulation, it really still, yeah, you've seen some changes. You've seen this, ball where it goes up and it's gone up for years, and then now people are expecting it to fall so far. But if we get back to, and I feel like we're still in an anemic price point, and also an anemic, not price point, but inventory amount, I see, especially at 3182, it's an average of what we've experienced, about almost 5,000 listings, 6,000 listings throughout the course of 2017 to 2019. We take out COVID because COVID was different. It's not a normal year. We realize that. We take out that 2020 mark, and then you look at, the inventory peaked in the Great Recession, 2006, 2007. So it was pretty much spot on. 2007 was 17,898. And then 2006, it was 16,006. So that gives you, a little information. Then in 2021, it peaked at 2,537. So what I see reading this graph and the data that I see is, I find it hard to believe that we are going to go into another Great Recession. If that's the case, and we would have to have a large spike on homes. And granted, I know people are saying, well, I think that there's going to be a large flux in foreclosures coming up. I think it's going to be, something challenging with people losing their homes and being in a scenario where they feel like, they can't make the ends meet for really to even pay their payment. So, with all that being said, we got to look at active inventory. Granted, it's gone up. It's gone up since 2021, but now we're, in the ballpark of what it was in November, December of 2020. So, and then in 2019, we were significantly higher in the ballpark of about 7,500 listings active in like June, July of 2019. So that, ladies and gentlemen, is something that you got to keep in mind. So we're tracing it back. We don't know exactly what the Feds are going to do, if they're going to continue. This was kind of a rant on, the Feds are saying they're going to raise it 0.5%. Initially they were talking about 0.75%, and they've been doing that significantly. But that being said, I don't think they're going to be doing that where it's a massive increase. They may do a 0.5%, but there's not inventory there to ultimately collapse the inventory, and it's not going to force a ton of prices down. Just, people are not as transaction-ary as they used to be, because they got to save some ducats for, the rainy days. So that's really what you have to think about, dude. You have to save some money to make sure that, if it does get a little bit worse before it gets better, those scenarios, those situations is really what is key as you go forward in 2023, and making sure that, okay, well, are we going to have this huge, massive crash? No, the Feds are probably going to still slowly raise the rates. But as you look at it, if we go back to this Wall Street Journal article, it looks like, we peaked at 9.7%, and then now we're at 7.1%. So we're 2% less than that. They'll continue to raise rates to tamper that CPI. But as they tamper that CPI, it's still going to slowly go down. So even if by the middle of next year, we're at 4.5% or 5%, they may still raise interest rates, but they may raise them like an eighth. To really make sure that it's still within their, grasp if it gets out of hand again, but they can also take it and, slowly marginalize those increases versus going significant, like 1% or 0.75%. Those types of things have really changed the landscape of the market, but I don't see any type of crash coming out. So, this is just, my thought process. And now, do I see like an interest rate market that we're going to be in the market of 10%, 12%? I don't think so. I think they're going to raise them, but we're still in a good market right now. And we're still, price wise, we haven't even hit 8%. Not saying I want to hit 8%, not saying that we should hit 8%, but interest rate wise, we haven't hit that. So, thanks for listening, and hopefully you guys check me out next week.